Everyone is asking themselves the same question. Is the stock market finally at the bottom, or is it just in the middle of a much, much larger sell-off? In this video, we're going to be looking at some pretty important data to try and answer that question. I'm sure a lot of you guys already saw the market today, but it is brutal. Over the past 3 trading days, the S&P 500 just got destroyed. The S&P 500 went from around $4,100 all the way down to $3,750 in just 3 trading days. It's been brutal, and this week will be one of the most important weeks of the entire year in the stock market because of the FOMC event right after a disastrous inflation report and a falling stock market. So let's look at some important data to try and answer the question of whether or not we're at a bottom or we're just in the middle of a much larger sell-off. So here's the thing. There's this awesome Twitter account, Charlie Bilello. I don't know if I said that right, but either way, he comes out with a lot of great posts and a lot of great data, and we can see from 1928 to 2022, the worst starts to the stock market of the year for the first 111 trading days, and how the stock market reacted for the rest of the year. In 1932, the stock market was down by 39.4%, but it ended up the remaining 112 days up 40%. The 1940, stocks fell by 27.8% in the first half of the year and then rebounded by 17% in the next half of the year. 1962, fell by 18% first and then rebounded by 8%. You could say 1970, fell by 17%, rebounded by 20%. Generally speaking, when the stock market has a terrible start to the year, most of the time it rebounds back up in a pretty big way, or even when it does continue to sell off, it's normally not as bad as the first half of the year. But while this data is relieving to see, it's not telling the full story, because basically whenever the stock market was was against the wall, you can say, or was up against the ropes, the Federal Reserve would come in just like they did in 2020 during the COVID crash, and they would just print trillions of dollars and make the market just blast right back up, just like we saw in 2020. You know, we had a recession in 2020, and of course the world was shut down and a lot of bad things happened, but the stock market blasted up because the government just pumped it up at an insane pace. But this time it's different because interest rates are already so low. So it's like the problem is that when you have interest rates already at around 1%, you can't just continue to cut interest rates because there's no more room to go unless you want to go negative, but that's not happening. So anyways, the Federal Reserve is in a tough position because it's they can't just bail themselves out, and they can't bail the market out like they did in the past. They can't do that this time. So now what we're seeing happen is basically the exact opposite. Like in 2020, what we saw, our bond prices basically rise up, which made yields fall down. Now we are seeing bond prices get destroyed, which makes yields rise, which is exactly why we're seeing, if you listen to the news every day, you can see bond yields soar. We've been hearing that for almost every day for the past year or so. So 2022, it's been in the news every day about bond yields soaring, and that's investors selling off bond yields. So unlike 2020, when the Federal Reserve and the government was buying up bonds, they're actually selling off bonds right now, and that is really having an impact on the economy overall, and also just stock valuations. Check this out. Let's say we go to AMD. This is a random example, but let's say we went to let's say we looked at AMD for a 5-year investment. Years of analysis 5, and let's just say, as a random example, you assume 9% revenue growth and a price to sales ratio of 6.71. If you looked at AMD 1 year ago, if you looked at the 5-year treasury to see what the risk-free rate would be, you can say that the rate was around 0.7, right? So if you wanted an extra 1% return because you're investing into a stock and because it's riskier, you might require your annual return percentage to be around 1.7%. That would mean that you could pay $127 for AMD stock. But when you see rates rising like they are now, that 5-year treasury that was paying 0.7% 1 year ago is now paying 3.4%. That is a gigantic jump. That is insane, and that's not really too. It's not that good. But anyways, let's say right now it's at 3.4%. So let's say you require like a 4.5% return on AMD now because of how fast bond yields are rising. You can see how AMD's price target gets cut from $127 all the way down to $110, and that's just one very brief example. A lot of people would require their annual return percentage to be closer to, a lot higher. We'll leave it at that because of how quickly these treasury rates are rising. So basically, with inflation so high, the government is, rising rates to kind of slow down inflation, but with that kind of comes hurting the stock market right now too. And the main problem is that, like, unlike almost every other drop in stock market history, the government was able to bail us out or bail a stock market out in some way or another. The problem now is, if they do bail a stock market out and they somehow lower rates or do something really foolish, the stock market might pop up in the short term, but that'll create a much, much worse problem in the future that it wouldn't even be worth it. We'd have maybe hyperinflation or just a horrible economic event like that. And I don't think the government would do that. And I think that's why they continue to rise rates, because they have to, because inflation's so high. So as you guys can see, the stock market is at a weird point right now where the government can't really do too much like they were able to in the past. So here's the main thing I'm watching. Right now, I basically have the S&P 500 and the U.S. 2-year Treasuries plotted on the chart. We can see that for the most part, over this past year, when we see Treasury rates rise up, the stock market tanks down. This goes hand in hand with this example I showed. When you have rates rising, you can pay less today for stocks because they're worth less. That's just, money in the future is worth less today, especially if inflation's high. So anyways, the main thing I'm watching is bonds right now. Treasuries, you call them either or. Basically, when these are blasting up, it directly impacts the current valuations of stocks. So what I'm watching is for these treasuries to calm down. If they just go sideways or if these yields start to fall, that is good for stocks. We can see when they calm down and they fell a little bit over the past couple of weeks, excluding the past 3 or 4 trading days, stocks blasted up. We can see other times over the past year or so where when treasuries kind of calm down, the stock market does a lot better. But when they rise at a rapid pace for the most part, the stock market gets destroyed. We can see at one point we had treasury yields rising and the stock market rising in the 3rd week of March. Just a couple weeks later, the stock market got destroyed. So in my opinion, as long as this treasury yield calms down, the stock market should hold up fairly well. Now, the multi-billion-dollar question is this yield going to calm down? But that's what we have to wait and see. And we won't really know until Wednesday, which is the FOMC event, and that's when Powell speaks. So the market's crazy right now. It's very, very rare to see a situation like this. If we do go into recession, I believe that this recession will be much, much different than previous recessions because the whole scenario is just different, especially given the level that rates are currently at and just what we have going on in the economy right now, especially related to inflation. It's crazy and it's out of control, but we'll see what happens. Let me know what you guys think about the market right now. Do you think it's the bottom, or do you think we're just in the beginning stages? Let me know in the comments down below, and make sure to join the StockedUp Discord. It is completely free. It's going to be that first link in the description and the comments down below. Join up. It's free. Tom and I post day trades every single morning for free. You can network with a bunch of other great people. It's an awesome community. Join up, and let's have a great week.